I've just been taking a look at the latest property data from Nationwide published this week, and they say that UK house prices went up compared to last month and are only down just 3.3% compared to this time last October. Now, this means that the current average UK house price is £259,423. Now, for some perspective, the peak in UK house prices happened back in August 2022, at least recently, when the average sat at £273,751. That's a drop of 5% from the peak. So much for the property market crash of 2023 that everyone here on YouTube's been going on about. But does this mean that the crash everyone was expecting isn't going to happen? Is the data lying to us, and what's really ahead? So let's start on the current data and dive a bit deeper. I thought 2023 was going to be the year of the housing market crash and we'd all be looking at 30% off. At least that's what some of the thumbnails on YouTube would have had you believe. We've got a cost of living crisis, a mortgage time bomb, and rising interest rates, which should be the perfect storm if you ever wanted to reduce those prices. Maybe we're missing something, and first let me take you back to something that rarely gets brought up and spoken about. If you want to understand house prices, you also have to understand inflation. You see, if you leave out inflation and you forget to talk about it, you end up in a position where you can easily come up with the wrong conclusions. For example, if you say house prices are the same as they were last year, just say a house you wanted was 250k in 2022 and it's still 250k today, that house has not stayed the same in value. The house, in real terms, has actually fallen in value because of inflation. Now, we all know how much of a hard time the UK's been having with inflation at the moment. Almost everything you buy has gone up in price way more than most people have got paid. The latest figures show that over the past year, prices have risen 6.3%. And yes, before you go in the comment section saying inflation is way more than that, that's just an average and we have to start somewhere. Many people in the UK will experience inflation a lot higher, as it depends on what things you actually need to buy. Now, typically poorer households experience higher levels of inflation. In fact, the ONS themselves state annual inflation for low-income households was 10.5%, and even worse at 12.1% for subsidised renters. Now, just going back to the point on house prices, if inflation runs at 6.3% and your house price stays the same in a year, then technically you've lost 6.3% in value. That 250k house would need to rise to 265k to stay the same in value over the last year. So where does that leave these house prices? Because none of this data takes inflation into account, and this might be something covering up the real fall in house prices. Here on screen now is a chart showing UK house prices adjusted for the effects of inflation. This blue line here tracks these real prices by taking the actual price of the average house and then adjusting the price going all the way back to 1976. Then this red line shows the trend in house prices. You can see two things very clearly here. Firstly, real house prices are nowhere near the craziness seen before the global financial crash in 2007. House prices in real terms back then were more than 330k, so that would be today's price plus another 30%. And then moving further along the line, you can see the real house prices haven't really done a lot over the last 10 years, even though you'd probably guess house prices have moved up a lot during that time. And while yes, that's true, the price has moved up. When you adjust for inflation, it's a whole different story. Even in just the last year, let's see what's happened. As an example, we've gone from around 300k in 2022 to under 260k today. Now, the headlines from the data told us that prices are only down about 3%. But a price fall from 300k to 260k is actually nearly 14%. So that's more than 10% worse in real terms when you account for inflation, which is something you have to do. Otherwise, you're not comparing apples with apples. Now back to the report. Nationwide's chief economist says a couple of interesting points I wanted to dive into. Firstly, he says that housing market activity has remained extremely weak, with just 43,300 mortgages approved for house purchases in September, around 30% below the monthly average prevailing in 2019. And then a second point which leads on nicely from this, he adds, this is not surprising as affordability remains stretched. Market interest rates which underpin mortgage pricing have moderated somewhat, but they're still well above the lows prevailing in 2021. So this is a really key point and something I'll touch on in a second. At the end of the day, the housing market depends on that key word, affordability. If people cannot afford to get a mortgage on their first house or cannot afford the payments on their current house, then everything will fall apart. Just as an example, imagine the average salary in the UK was 150k a year and the average house price was 450k. This would mean that the house is 3 times the cost of an annual salary. I'm sure some of you would love to be able to buy a house with 3 times your earnings, but let's get back to the real world. Now, the current market looks a bit like this. I've grabbed this data from Rightmove's last report, which shows some very interesting things around affordability. Here's 3 key lines from bottom to top. You have average salary times by 4.5, Then you have the average asking price for first-time buyers, and then finally a salary for 2 people multiplied by 4.5 times. As you can see, on their own, an average first-time buyer is nowhere near where they'd need to be to get the average house, unless of course they have a huge deposit. But if you put 2 buyers together, then you realise that it's actually possible to get on the housing ladder, at least from an average price perspective. I think too often we say that house prices are too high and we base it on one person's income, but in reality, we have just to accept that it takes 2 people now to pay for a house, and when put like this, it does explain things to a certain extent. And what about when we break things down a bit further? You see, when you use average numbers talking about the housing market, I think this can skew things quite a bit. In reality, the housing market is made up of lots of different kinds of smaller local markets that many of you will know really well. I'm sure there'll be lots of great comments below telling me how in your area houses are either still selling fast or some sellers won't budge, or even saying that house prices in your postcode are very affordable and you don't know what all this fuss is about. Just on that note, please do comment and drop a like on the video. It really does help out small channels like mine. So, local markets. If we stick to the topic of affordability for a second, but rather than use averages, let's break the UK down into the regions. Here's what the picture looks like. On screen now is a graph showing what first-time buyers are paying on average compared to their salary. And remember how on the last graph, one salary, once you multiplied it by 4.5 times, was not enough to buy a first house? Well, what you're seeing here tells a very different story. If we look at these lines showing Yorks and Humber, as well as the Northwest, you can see that houses in these regions fall well below the UK average. So, as I just said, one person on an average salary can afford to buy a house here. Obviously, they still need a deposit, but I don't think you'd need to see a house price crash here to get the market moving. Areas like London, if we add that in, skew things massively, and clearly this is a problem for people on average wages living there. Not to mention that you end up also competing with huge amounts of investors and international buyers who seem flush with cash ready to snap things up. Anyway, interesting to look at, and a good reminder that the housing market is really just a collection of many small markets just all lumped together. You could quite easily have house prices fall in one area while staying in the same or just rising in another. Now onto the second point, again from the nationwide report that we need to address. And I think this point explains a bit more why house prices don't just all of a sudden crash as much as some people want them to. It says, the uptick in house prices in October most likely reflects the fact that the supply of properties on the market is constrained. There is little sign of forced selling, which would exert downward pressure on prices as labour market conditions are solid and mortgage arrears are at historically low levels. Okay, firstly a reminder saying that supply is constrained. This is a reminder that the housing market is a market just like anything else. It's all driven by supply and demand at any given point in any given area. The price of a home is only ever worth what someone else is willing to pay for it at that moment. And until that point, really it's just a guessing game to try and work out what your house might be worth. In Rightmove's last report, they highlighted this by saying that the number of buyers inquiring to each available home for sale is 8% higher than the more normal market of 2019. But then they also say that the proportion of homes that are finding a buyer has dropped from 8 in every 10 at the height of the frenzy to a more subdued sales rate of 6 in every 10, making pricing competitively more critical to really stand out. So clearly there's demand out there from buyers, but they're obviously a little bit pickier about what they want to pay. And they're probably coming up against sellers who might not be in tune with the reality of the market. Or let's not forget that not every seller even cares about selling. Some people out there just want to see what they might get as an offer, but really they'll not even move for that price or have some sort of fixed price in their head. Some interesting thoughts anyway, but the point stands that someone somewhere has to agree on a price to set the value of a home in any given market. Okay, so we've covered the issue with house price and inflation where real house prices are probably more than 10% lower than the peak of last year, and we still know that the market is tight in terms of supply. But are we missing something else? Because as much as we have all of this current data, we've got some pretty bumpy times ahead. Firstly, remember that mortgage time bomb that I spoke about earlier and covered a few months back? This is the name given to the issue that millions of households are going to face over the next 18 months as people move from very low interest rates to much higher ones. This is the issue caused by the raising of interest rates by the Bank of England in such a short period of time, because there's a lag effect until people actually feel the pain. The UK, as you'll know, operates mostly on fixed-term mortgages of 2, 3 and 5 years, so until your time is up, you're sat in a fixed payment that's been typically around the 2% mark, while rates were really low. Now that rates for mortgages are sat up around the 5 to 6% mark, depending on how much you need to borrow, the moment people need to remortgage will put hundreds a month on the average mortgage. At this point, over the next 18 months, this will surely have a big effect on the pricing of homes, as we would expect there to be many people out there who might end up having to be forced sellers. As usual, we go back to the supply and demand story. If there's more supply on the market in the next year as people are forced to sell, then we would expect prices to come down. How much they come down? Well, that's the £1 million question. But then also, don't forget that if people are in serious financial trouble and don't want to sell, I think we could also see some people extending their mortgage term for many more years to try and keep their payments the same. And even though this will cost them a fortune in the long run, I think it will be a solution to some people who don't want to be forced to sell. So as you can see, this is all a very careful balance, and it reminds me a lot about the stock market, which is something I talk mostly about on my channel. For some reason, just like the stock market, no matter how many times you tell people not to try and time the market, people still think they can do it. In the stock market, people love to call the tops and bottoms, and they always pretend that they know best, whether they tell you about it or not. And I feel like the same thing happens in the housing market. It's a weird obsession we have in the UK. Personally, I think you're playing a dangerous game if you want house prices to crash, as history should tell you that the trend is likely just to continue in one direction. There will always be short-term price movements and issues in the economy that affect the prices of homes, just like there is in the stock market every single day. The key thing for me would be to bring things back to what you actually want as a homeowner or someone who wants to own a home. If you want to own a home for a long time and you're wondering if now's a good time to buy or not, then isn't the question if you find something you like and you can afford it, then just go for it? Remember that there's always a risk by waiting, because you might be paying rent to someone each month instead. You might have money sat as a deposit doing nothing, and the house you actually want doesn't appear again. I really can't see prices fall like we had back in the global financial crash, and nobody wants to see houses being repossessed, including the banks themselves. But hey, maybe rather than a crash, we end up with a slower decline where things go back to some kind of normality. I have no idea. But either way, I think most people will do pretty well by not obsessing about the price of their home if they're already a homeowner and plan to be there for many, many more years. Imagine an estate agent coming to your house every day and giving you a different price for your house. Do you really care what they say if you intend to live there for the next 10 years? It might make you feel scared if they give you a low number and excited if they give you a big number, but really changes nothing. Saying that, I'd love to get your opinions and views in the comments. Am I being too optimistic, too naive, or maybe ignoring something else? Let me know what you're going through at the moment, good or bad. I'm sure lots of other people would enjoy your view as well. And on that note, see you in the next video. As always, happy investing.